This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Ahead of Apple's highly anticipated iPhone event on Tuesday, Qualcomm did announce today that it will supply the company with 5G chips for its iPhone launch across the next 3 years. The agreement suggests that Apple is having difficulty developing its own wireless semiconductors, but there are indications that Qualcomm still expects Apple to eventually use its own internally developed semiconductors. So to dive deeper into this, we're pleased to have back with us Mark Gurman, Chief Technology Correspondent at Bloomberg News, on the phone in Los Angeles, along with Anurag, Rana, Senior Technology Analyst at Bloomberg Intelligence, on Zoom from Chicago. Mark, I'm going to start with you. You wrote this story about Apple and Qualcomm on the terminal with Ian King earlier today. Walk us through this and what we need to know about the latest developments here with Qualcomm as well as Apple.
So for the past several weeks, Qualcomm and Apple have been in negotiations about extending their supply agreement for 5G modems. Qualcomm is the best modem maker if you want 5G. Apple has the most expensive phones. They want phones that work properly, and so they had to give in here yet again and work with the supplier that they've been embroiled in lawsuits with, and quite frankly, just don't like. In Qualcomm, they have a new 3-year agreement. That means it's going to run for the next 4 iPhone generations, including the one to be announced tomorrow on Tuesday, the iPhone 15. And this will allow Apple to have proper 5G for the next few years. And this is also in response to Apple not being able to get their own internal modem up to snuff. They've been working on this since 2018. Their goal was to get that modem into the iPhone by now. It's going to take a little bit longer, and this reflects that.
Mark, based on your reporting, what's the holdup with the modem? What do we know?
There's a few things. There are battery life issues. There's also problems in certification. To get a modem to work, you need it to work just as well, if not better, than the Qualcomm chip. You need it to work in every country, on every carrier, across 3G, 4G, and 5G. That's clearly taken more time than Apple has anticipated. Qualcomm has been at this for decades. They're the market leader. They're the best. And so Apple really had to fold here if they want to continue selling what they consider to be the best phones.
I want to bring in Anurag Rana, Senior Tech Analyst at Bloomberg Intelligence. He joins us from Chicago this afternoon. Anurag, in this story, and based on Bloomberg data, we see that Apple is Qualcomm's top customer. Nearly a quarter of Qualcomm sales come from just Apple, 22.3%. Does Qualcomm need Apple more than Apple needs Qualcomm?
From our side, it seems, for Apple's viewpoint, they're always looking to, upgrade their hardware so that they can do new and unique things, which we saw in the case of Intel. Now, from Qualcomm's point of view, I don't cover Qualcomm, but, I've heard from our analysts that, they are expecting down the road that they will be, decoupled from Apple. But, from Apple's point of view, it's not going to have material impact on financials anytime soon. And we don't think they're doing it to save any money. They're just, they just want to make sure they have the best equipment for their phones.
What about when it comes to so much discussion about Apple's reliance when it comes to China? How does this fit into that picture when you are talking about also Qualcomm?
I think Apple's reliance... Sorry, go ahead.
Oh, no, continue. I was just directing it at you in case Mark was thinking I was tracking to him.
So, the China-Apple relationship is complicated, and it is, we'll figure out how it's going to be tested over the next 12 months. And I think I give credit to Mark because he talked a lot about it last week when the news came out that Apple's iPhone has been banned in some of the government agencies. From our side, Apple is very much dependent on everything China for its supply chain. It also generates about 20% of its revenue from that area. So China is very much important for Apple and its future.
Mark, is Apple actually successfully decoupling itself from China in any significant way? We see occasional headlines about moving iPhone production to India and whatnot. But as Anurag said, 20% of the company's revenue comes from the region.
I think move is actually the wrong word, and, it's a word that I've used many times, and so maybe it's my fault. But I'm not sure move is the word at this point. I think it's more so augment, because they're not tearing down any of the lines they have in China. Apple is still, believe it or not, in growth mode in terms of new SKUs, new types of products, more units in some of their product lines, AirPods, Macs, and iPhones in some regions. And so, they're adding more production lines in places like India, Vietnam, not necessarily tearing down those China lines. So I'm not sure it's fair to say a wholesale move or a wholesale decoupling has happened yet. It's certainly the goal. What I'm told is they want to move up to a fourth of iPhone production from China to elsewhere, but that really has not happened yet. And once they have enough lines and augmentation set up in other countries, then they may be able to pare back in China itself.
Hey, Mark, especially with the iPhone launch for the 15 coming tomorrow, what do we need to know heading into this event?
Well, certainly you can bet on it having a Qualcomm chip. You can also bet on the Pro models being produced in China, just to, flick towards what we're talking about today. But the big changes will be a titanium case, more durable, lighter on the Pro models, better battery life on some of the models. You'll also see thinner borders around the screen on the Pro models. In the lower-end iPhones, it's basically they'll be recycling last year's Pro features, the dynamic island and the 48-megapixel back camera and the A16 chip. So really something for everyone tomorrow. One thing to watch out for, I think, will be a little bit of a price increase in some of the Pro Max models. Also higher performance chips for the Apple Watch, which I don't think is going to spur any upgraders in the last couple generations, but could be good to bring new people into the fold and people on older Apple Watch models, and also some new changes to the AirPods.
And Anurag, on the Bloomberg Intelligence side, what are you going to be watching for?
I mean, for me, it's only the pricing that I care about, frankly, because that's what's going to dictate revenue growth for the company, because unit shipments are going to be very tough to grow this, the next 12 months or so. We expect a very modest increase in that. But if we can get a good price bump in the Pro Max model, I think that can help Apple, grow their iPhone revenue next year.
What's a good price bump in your opinion, Anurag?
I mean, I think 5 to 6% overall on a totality, the portfolio. Mark's mentioned maybe $100 more or so on the unit side, but we think if the portfolio itself can grow 5 to 6%, that's a very good, healthy growth for iPhone over the next 12 months.
Hey, Mark, any sort of one more thing in the parlance of Steve Jobs?
I'm not anticipating any breakthroughs or major surprises. I think it's going to be pretty cut and dry and straightforward. 4 new iPhone models, updated AirPods, the shift to USB-C, new Apple Watch Ultra, and the Apple Watch Series 9. And I think that's a pretty good event. Don't forget those 3 products, that ecosystem together, the iPhone, the Apple Watch, and plus the AirPods, that's 60% of revenue right there.
Wow.
So, based on that, most important event of the year.
Neither of you guys said anything about the Vision Pro.
There won't be anything on the Vision Pro tomorrow. Maybe they'll flick at it or tease it in some respect, but you won't see any news or new demos or anything like that. Not till next year.
Anurag, in 20 seconds, is it even on your radar as an analyst covering the company?
Oh, the mean Vision Pro?
Yeah,
it's fun to talk about, but financially, it's not going to move the needles. AirPods itself is going to be gazillion times more important than the Vision Pro, even 3 to 5 years from now.
Well, I've bought a gazillion pairs of AirPods because I've lost them and they've run out of battery.
That happens to me all the time too.
I'm a big believer they should move it from into the services category because of the recurring revenue that I and so many others provide to Apple as a result of us losing our AirPods.
I agree.
Hey guys, we love it when you join us. Really big thank you to both Mark Gurman, Chief Technology Correspondent at Bloomberg News, and also Anurag Rana, Senior Tech Analyst from Bloomberg Intelligence, joining us on the phone from Chicago.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
All right, we were just talking about this Merger Monday, JM Smucker agreeing to acquire Hostess brands. They make ding-dongs, Twinkies, Zingers. I haven't had any of those in a long time, Jess.
It's been a while
Yeah,
since I've had any of the above there.
Should note, this coming after Campbell's Soup moved to bulk up last month when it came to shelf-stable aisles. Saying goodbye Sovos Brands, they make Rayo's tomato sauce. That was a $2.7 billion deal. And then we got the IPOs coming in the wake of ARM filing its S1 earlier this month. Instacart and its backers set the stage for an IPO that could value the grocery delivery business at as much as $9.3 billion. That's less than a quarter of what it was worth at the height of the COVID-19 pandemic. Liana Baker is managing editor of the deals team here at Bloomberg News. Bailey Lipschultz is equities reporter for Bloomberg News. He covers a lot of these IPOs. Both are with us right here in the Bloomberg Interactive Brokers studio. Liana, I want to start with you. Is it really a merger Monday? It feels like it.
I would say when there's a brand that people have actually heard of getting acquired, let's call that a merger Monday.
And Hostess is a brand that we've heard of.
Definitely. And it's been sold and bought many times before. It's gone public through a SPAC before SPACs were popular. That's something Bailey knows well. But in 2016, it did go public through a SPAC. So I think this is a good outcome for them. We were a bit surprised that JM Smucker kind of came in to win this one. There were other names rumored to be around it.
Wow. Who knew that ding-dongs and Twinkies and Zingers were all the rage?
It's all coming together now.
I mean, Bailey, can you speak to that? Like, what's the deal with the shelf-stable stuff that these companies want in? And I mentioned Rayo's tomato sauce, which, I mean, I think we can all agree is actually delicious.
I mean, I'm not a big fan of Twinkies, to be completely honest, but I do think it's part of just expansion and ability to grow.
Yeah.
And like when you look at this, as Liana mentioned, my favorite D-SPAC of all time, because no one knows it's a D-SPAC, that along with Utz. But when you look at some of these deals and the reception from Wall Street.
Food brand.
Exactly, yeah. Utz, DraftKings. But if you look at the reception from Wall Street, optimism from the acquired company, but not so much the company actually buying it when you look at SJ and worst performer, one of the worst performers in the S&P this morning.
So why was that?
Could be ARBs. Is it ARBs, Liana?
When you see companies do big bets, the buyer stock often goes down. It's just, what happens in a more gangbusters M&A market. That's when you'll see buyer and seller stocks go up on deals. That's when we say deals beget deals. It definitely is a big bet for JM Smucker. I would say it's a bit of a surprise to the market because other names had been linked to Hostess and not this one. Although Uncrustables was getting a lot of press in the
those are
lead
good.
up to
All right, can we agree on Uncrustables are delicious? They're set to be $1 billion brand in a few years. Just Uncrustables.
So I wonder what they could do with Hostess. Maybe there's some, collabs they could do.
Jess, have you had Uncrustables?
I have not. What is this? Please
it's
explain.
like a peanut butter and jelly sandwich that comes in what looks like a pita that's
Bailey
really
looks so
sweet,
shocked.
and you keep it in the fridge.
Apparently
did I do a good job?
No, that's
describing
perfect. If you pop them in the freezer, they're even better, I will say.
Okay.
Pro tip.
Well, I need to get in on this.
All right, so Liana, are we? We haven't talked to you since Labor Day, and the whole idea here was that there was going to be this big surge in M&A and IPOs and deals. You lead the deals team. Is that happening?
So I think we're seeing some positive signs. If you look at the Hostess deal today, it's being funded by bank debt. There's traditional banks funding this deal. That's a great sign. It's not like some bespoke private credit situation. So the more we see financing come back for these big deals, that is a supportive signal that we could see more. After Labor Day, I don't think we were expecting a huge boom in M&A, although with the year, with only 4 months to go, there's not a lot of time to get all these deals done. But I would say the IPO market is the one to watch now. That is where all the activity will come from for the rest of the year.
Well, speaking of IPOs, because that's something Bailey is all over, talk to us about the number of IPOs that are coming along the pipeline here.
Well, we've got ARM, which is expected to price post-market Wednesday, debut on Thursday. Expectations for early to mid next week. The same thing happening with Instacart. Obviously, that is a household name. SoFi is one of the underwriters selling it to retail traders, so expect a lot of excitement around the name. Granted, the valuation is, as Tim mentioned, more than a 75% haircut based on the high end of that range.
Wow. What happened?
COVID ended, really, to be honest. When you look at some of the growth, when you look at the underlying fundamentals and talking to people who are looking at these things, a lot of the transaction volume has slowed. They turn profitable. They have 5 quarters of profitability, but the big focus is how can you continue to expand growth? And when their number of transactions, their transaction size is actually staying pretty modest in terms of growth. Expectations are maybe not that it's going to be gangbusters. And Liana, I'm sure you could speak to this. This isn't necessarily an IPO, at least from my sources, that it's coming from a time of strength. It almost feels like a need to get on the public markets.
Instacart is one of those companies that has been flirting with going public for years. There's a ton of VCs behind it, and they've ousted their founder. There's been a lot of drama there, so it'll be a welcome event for the VC community to have this one out there. And there's many more companies waiting in the wings. On the same timeline as Instacart is another company called Klaviyo, which the valuation isn't that much different than Instacart, but no one's heard of it. Klaviyo with a K. But it also has VC backers. And I think that's an important one to watch because it's more of a bread and butter tech IPO. And the class of 2024, the IPO class, could do big numbers if we see names like that do well out of the gate.
When you think about Instacart and potentially cutting its value to around $9.3 billion, is that more unique to that particular company, or is that something that you think these other firms that are trying to go public could face those issues as well?
I think Bailey mentioned it, how COVID ended, and that was hard on Instacart. So I think that's an Instacart-specific situation. Their internal valuation had been around $13 billion last fall, so $9 billion isn't that much of a drop, and it could still go higher depending on how demand is going. The roadshow is only starting today, so they have a week to meet with a lot of long-only investors, and maybe there will be pent-up demand and it'll do well. Maybe it'll be worth more than $10 billion. So we'll see. Those first-day pops are going to be something that the investment bankers are going to try to engineer. So this will be a successful, fall class.
Well, Bailey, speaking of roadshows, the chip designer ARM considering raising the price range of its IPO after meeting investors, and it could still be the world's largest listing this year. So kind of an opposite story there. What's going on with ARM now?
Well, as the deals team has been all over, you look at this is an offering that's already on the terminal oversubscribed by 10 times. So you're looking at this demand, you're looking at the valuation. Actually, what they flipped at was smaller than many on the street were expecting, smaller than SoftBank actually bought back the chunk. That was valued at $64 billion. So it seems like, again, talking to people in my conversations, maybe a little bit of an under-promise, over-deliver, and that's why you're looking at expectations around a lot of excitement. SoftBank not selling a ton of the stock, also having strategic investors, which can help really firm up the debut, firm up that day one pop that Liana was mentioning, which obviously gets excitement, gets the headlines, and gets more deals potentially off the sidelines.
So is that an optimistic sign over the next year that potentially we could see more of these deals down the pipeline? Obviously, when you think about the backdrop of how many issues there have been because of higher rates and things like that, we only have about 40 seconds left. But do you think that this is an optimistic signal, or what else is ahead?
I haven't talked to anyone who's not optimistic about at least the first half of 2024. And that really is consensus, especially ahead of an election. It seems like the fundamentals are there and there's interest there for both buyers and sellers to get out at the start of next year.
I'm curious, do you think that that would really tell us that there is a recession on the horizon if you have something like this happening in the economy?
It's hard to say, but it can't get any worse for IPOs right now. Like, there just haven't been many. So everyone is optimistic that if there's some IPOs, that's going to be, a really good sign, because there's been nothing to really compare it to.
I mean, this is the managing editor of the deals team talking. Like, she wants to see some deals. So, I get it.
She's ready.
Liana Baker, managing editor of the deals team here at Bloomberg News. Bailey Lipschultz, equities reporter for Bloomberg News, covers IPOs, covers SPACs, and more. Really appreciate you guys joining us this afternoon from the Bloomberg Interactive Brokers studio. You're listening, you're watching Bloomberg Businessweek. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, it's a privately held company. They've got a valuation of more than $60 billion. It's got the largest share of the U.S. fast fashion market. That's according to data from Bloomberg Second Measure. It's backed by investors including Sequoia Capital China and Tiger Global, among others. And last month, it acquired a stake in its rival fast fashion retailer, Forever 21. It seems like everywhere you go today, you hear about Shein, the China-founded but now Singapore-based fast fashion retailer. We're very pleased to have with us Peter Pernot-Day, U.S. Head of Strategic Communications at Shein. Peter's with us in the Bloomberg Interactive Brokers studio. Peter, how are you?
Oh, I'm doing well. It's so good to be here today, and happy to share a little bit about our business.
Yeah, it's good to have you with us. It's pretty amazing the way that Shein has just come on the radar now. I mean, you guys say you have 150 million customers around the world. It's a rocket ship.
Yeah, I mean, we've seen extraordinary growth, and I think our customer-led model has really allowed us to resonate with our core customer base, and we've seen tremendous growth because of that product market fit.
So what's the status of the IPO plans?
We don't have any current plans to IPO.
Is that still a goal?
I mean, there are lots of goals for the business. I think that could be one of them, but there are no current plans to pursue an IPO.
Do you think, I mean, you have some very prominent investors, as I mentioned, Tiger Global, Sequoia Capital China. They want to see a return on their investment. Is there any path that's not an IPO for an exit?
I mean, I'm not aware of one, but I don't think we have any current plans to IPO. Our position is really to try to increase our connection to our customers and to further refine the on-demand business model and flexible supply chains that have allowed us to produce a really pioneering form of fashion.
We'll talk a little bit about that. What do you mean by flexible and fast fashion? I mean, just how fast are we talking here?
So the Shein model is premised on something we call the on-demand business model, and that marries two technologies. The first is audience engagement and measurement tools that we host on our website and mobile app. And this allows us to understand our customers and how they interact with our products, what they like, what could be trending. And then we can take that information and in real time, using a digitally empowered supply chain, we can produce garments to meet actual demand. And this has two effects. One, it dramatically reduces excess waste. So instead of producing thousands or tens of thousands of copies of a garment, we can produce between 1 to 200 and then see if it actually sells. If it does, we can produce more quickly because we have this digital connection to our supplier base. The second impact is it allows us to work with small and medium-sized producers. And this gives us a lot of flexibility. If one producer is busy or one producer goes down, we can pivot to another producer very, very quickly. And so the combination of these technologies has allowed us to produce a really pioneering model that we call the on-demand business model. Now, your question is to time. It can be as short as 10 days. It can be as long as a month. It really depends on the particular design.
Are you guys using AI at all?
We don't use AI. And I think one of the things that we've talked a lot about in the last couple of months has been that our model is really an example of augmented intelligence. So we're using solutions like machine learning, which is a species of AI, and then we're marrying that to an analog supply chain. And that analog supply chain is still someone who has to actually make the garments, who has to load it onto freight shipping, has to deliver it. And that's something that we've optimized through this augmentation with machine learning.
Talk to us about some of your other goals, because I know one of them was trying to move more of the production outside of China. Where do you stand on that at this point?
So one of our key goals is to become a localized company. And what that means is we want to be closer to our customer bases and their core geographies. So we've established a major presence in Europe. We've established a major presence in Brazil. We obviously have had a long-standing presence in the United States. And what we've done to augment that is back it up with some infrastructure. So we've begun to work with manufacturing partners in Turkey. We've begun to work with manufacturing partners in Brazil. We're exploring other geographies. And this allows us to be closer to our customers, both in terms of our corporate business, physical retail, not physical retail, but things like marketing, HR, legal departments, but then that's backed up by an infrastructure that includes shipping, logistics, and possibly contract manufacturing.
Well, speaking of physical retail, I mentioned the stake that you acquired in the rival fast fashion retailer Forever 21. Part of that was establishing a brick and mortar presence here in the U.S. Talk to us more about this partnership. I mean, how does it benefit Shein, and are you going to be looking to do deals with other U.S. companies?
So I think that the Spark deal that includes Forever 21 was a tremendous opportunity to find synergies between brands that really are interested in being customer-led. And I think that's what drew us together, is there's a strong customer centricity to both of these brands. It's still early days, and so we don't know exactly how things will shake out, but it is possible that you will see some exciting collaborations around physical retail, which would be an extension of some of our pop-up stores that we've launched. We did about 40 in 2022, so this could be an extension of that model.
Are there other partnerships that you're planning to roll out soon?
Well, we've recently launched a marketplace model, and we're always looking for new brand partners who are interested in our on-demand capabilities, who are interested in our customer-led focus. And so we never say no to potential brand partnerships, but I don't have anything specific today.
I got to ask about some of the controversy that's surrounded the company. Of course, there was the influencer trip to China. Whenever we talk fast fashion, there are concerns about the environment. You brought up some of those concerns about the environment. There's been the discussion about the use of forced labor when it comes to producing these garments. What is Shein doing right now to clean up its image here in the U.S.?
So I think the first thing that we're doing is correcting misperceptions. We have zero tolerance for forced labor. We do not have any contract manufacturers in the Xinjiang region of China. We have a comprehensive supplier management program that includes audits, codes of conduct, third-party testing using radioisotope analysis. And so we're really trying our best to make sure that we are a responsible global brand. And I think in terms of some of the other criticisms, we would say that we are working to address our growth as a business. So that means investing in our ESG initiatives, it means investing in stable partnerships, and it means really sharing what we are as a company. Part of the waste less production that we do, the on-demand model itself, is I think something that can add an important piece of the conversation to sustainability. It's not the total solution, and work remains to be done, particularly on post-production waste, but I think our model is something that could actually be a template as we move forward in the future of garment production. So I think to sum up, there's a lot of misperceptions about us, and we're trying our best to address those.
What does sustainability mean to you?
So for us, sustainability is about having both a financial component, which means something that is good for the business, and also a planetary component, something that's good for the planet. One of the examples in which we've tried to leverage this is a partnership with a company it's called Queen of Raw. And Queen of Raw uses SaaS technology to aggregate global dead stock supplies. And then we can go forward and purchase dead stock from other manufacturers and convert that into net new garments. And so this is a way to use material that would otherwise go to waste and put it back to productive utilization. And I think that's an example of sustainability, at least as we define it at Shein.
What's the biggest surprise to you about how the company markets itself and how people find out about Shein?
One of the best parts of my job is I get to travel around the world and talk to Shein customers, and I'm always amazed at how deep a connection we have with them. The number of customers who've come up to me and said, I love Shein, or Shein is a way that I can connect with my kids, and we buy matching outfits and we buy matching costumes. Or other customers have come to me and said that they love our pet offering and the way that our pet clothes allow them to engage with their pet in a new way. To me, that's the best thing. And I think it points to the success of our overarching value, which is we want to be customer focused.
What's the top question that you get from your customers?
So I think many of our customers are very interested in our sustainability. I think they're very interested in our social compliance, those two questions that we discussed earlier. I'd say those are two of the biggest ones that we get.
Do you offer any sort of clothing recycling program at this point?
We are exploring clothing recycling, and I think that could be a feature of our partnership with Spark, but I don't have a specific program at this current time.
Meaning we could perhaps envision something where you would bring in old Shein clothing to a physical location that would then be repurposed.
That's right. But beyond recycling, we have a peer-to-peer resale offering. This is something called Shein Exchange, and this is where Shein customers can go to our retail exchange, which is on our app, and they can sell back pre-loved clothes to other Shein customers. And since its launch, we've had over 1 million customers sign up to participate on this resale exchange.
Hey, Peter, really appreciate you joining us today here on Bloomberg Businessweek. Peter Pernot-Day is U.S. Head of Strategic Communications at Shein.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, with just under 20 minutes to go before the closing bell here, taking a look at the S&P 500, up about 0.8%, with discretionary leading the way, up almost 3% there, especially when you think of names like Tesla in there that did get an upgrade from Morgan Stanley earlier today. But if you look kind of under the hood here, as you know, Tim, obviously central bankers in a blackout week this week ahead of the Fed's decision on September 20th. But we do have that CPI data that we continue to talk about due on Wednesday. And traders are also obviously waiting for Apple's iPhone 15 event that is coming tomorrow. So a lot of different things going on this week, but who better to join us now and talk to us about this than Doug Ciocca, CEO at Kavar Capital from Leawood, Kansas, joining us right now to break through what he's watching in the markets. Now, Doug, thanks so much for being back with us. Talk to us about your view on today's rebound after the S&P 500 did snap 2 consecutive weeks of gains last week.
Yeah, thank you for having me on. I mean, it's always encouraging to start Monday off on a good foot. I think, like Bill had mentioned, and you corroborated as it relates to consumer discretionary between Tesla and Amazon, and obviously the Tesla move on the heels of a really strong upgrade for Morgan Stanley, kind of moving away just from the auto emphasis of the organization and kind of stretching out to what a lot of people knew it might have kind of widespread impacts across EVs, communication, and now, of course, supercomputing. So a little bit of a tailwind, maybe in the hopes that the last 3 weeks had taken a little bit of the wind out of the market sales and kind of preparing, like you said, for Wednesday and Thursday with CPI and PPI. But a nice start to the year. The bonds are pretty flat across the curve.
Hey, Doug, good to have you back with us, by the way. It's been a long time since we spoke.
Yes.
So do you buy this? I mean, I know, that maybe you're not prepared to talk Tesla, but you brought it up, so I wanted to get into this because, I mean, it's up 9.9% right now. And Adam Jonas over at Morgan Stanley is saying that software and services revenue are going to become the company's biggest value driver. We're not talking about Apple here. We're talking about Tesla, an automaker. Right. Do you buy it?
Specifically about Tesla, like you said, Tim, we're kind of have a prohibition on diving into individual equities. I think what the market is looking for is substantiation on some of the thinness that's led the rally to this point. And you look at kind of consensus on EPS, about 250 next year, which is 18 times. And if you then strip out the biggest 10 companies in the market, well, they're only really trading at 16 to 17 times. So I think momentum being such a strong factor, and it has been kind of riveting as it relates to kind of the broad application of some of these very large sort of FANG in the Magnificent Seven stocks. There is kind of an enduring interest in substantiating what's sort of taken the market to this point, and it becomes kind of the path of least resistance versus trying to delve outside of that Magnificent Seven to find other areas that could be catalysts for the sort of the last quarter of the year.
When we're thinking about 3 key areas, especially to Tim's point earlier, talking about seasonality in September, if we're looking at, say, the dollar, yields, as well as oil, the direction of those 3, how crucial is that when you're thinking about the direction of where stocks could go as we try to close out the third quarter pretty soon?
Yeah, I think as much as all 3 of those would be important, I think the dollar value is the most, right? I think you saw a really strong move in the dollar the last 3 weeks. That had a very negative impact on performance underlying U.S. equities. I think some of the enthusiasm around like this enduring continued growth in GDP. I mean, shoot, the Atlanta Fed right now is at 5.6% for Q3. That's pretty incredible at this point of the cycle. So if that is going to materialize, how does the Fed substantiate a pause? And if they don't pause and we have to see a little bit more tightening, that then brings in the fear that they over tighten, which can not just slow the economy, but cause us to go into recession. So the dollar is what we're watching most closely. It's a little bit of a key to the kingdom as it relates to the underlying value and direction of our dollars in both equity and fixed income.
Doug, talk to us about international. It's an area when it comes to equities that you're bullish on. Why?
Yeah, we are. So the valuation discrepancy, Tim, right now is pretty pronounced, a multi-year wise as it relates to EPS. The other thing that we've seen, right, and it's been kind of a 2-speed recovery, right? There's not as much liquidity that has to come out of developed markets. We like EM as well, though China's just too big a wild card right now for us to get too super excited about. But we think given, number one, valuation, the disparity. Number 2, the fact that we're seeing sort of less depths of extraction of excess liquidity overseas. The third thing is, and this is a little bit nuanced, when you look at individual equities overseas, they're not spending a lot of their cash flow buying back shares because a big part of their incentive compensation does not deal with restricted stock units, ISOs and NQSOs relates to stock option comp. So more is being paid back out to dividends, which provide a nice total return contribution, but also being reinvested into the businesses as opposed to being used to repatriate shares.
I know you're watching 4,500 on the S&P 500 as a resistance level. What are you watching as a level for support?
Yeah, great question. We tend to think less in those terms and more on EPS. We just feel like at 18 times such thin breadth in the market. 4,500 seemed like a very dependable level. We're now at sort of a proving point coming through Q3 where we expect to see an elevation of the profitability across the S&P 500 companies. If that's true, then Jess, I could definitely see the market taking 4,750 to 4,800 going through the end of the year and into next year. You got to understand, if you're an asset allocator, and we are at Kavar Capital, this is an environment that you crave, right? Because you have low conviction in equities broadly. You've got elevating volatility finally. You have equal or close to equal opportunity between both stocks and bonds, and certainly within stocks and certain industry sectors. And we're in a rising profit cycle environment. With a monetary policy, that last thing really important, monetary policy backdrop, whose likely next pronounced move is going to be accommodative.
What do you mean?
We're not at a shortage of ideas, is the way of saying it.
Yeah, talk about that, Doug. The idea that it's going to be accommodative. What do you think it's going to be, and how is it going to be accommodative?
Yeah, so if you figure just historically on average, the sort of the status quo period between when the Fed stops hiking and begins cutting is about 10 months historically. Now that's skewed, right? Because we went through almost 10 years, right, coming out of the global financial crisis till 2016, when 2007, end of 16, when the Fed started to hike. So we really feel like it's going to be the amount of the liquidity they took out of the economy going from 0 to 5.5% begets the patience that's required on that known lag between impact and implementation. So we really feel like they're in a wait and see period, which I think is probably exactly where they need to be. Not to be understated, this is not a partisan comment, but election years have very strong influences on rates. And the most near-term example goes back to 2016, where there were 4 hikes that the market was pricing in, and we got none. So I do think we will have kind of wait and see. And ultimately, what ends up happening, and this has a very strong historical precedent, is once the Fed funds crosses above CPI, it tends to be a really good opportunity for fixed income assets. And that's reasons, there's one or two reasons behind that. Number one, Fed's gone too far, ultimately they have to cut. Number two, they realize, right, if they went so far that they actually go into recession, that's really positive for a lot of asset classes, notably bonds.
Doug Ciocca, we love it when you join us. Thanks so much for taking the time. Doug is Chief Executive Officer and Partner at Kavar Capital Partners, joining us from Leawood, Kansas this afternoon. This is Bloomberg Businessweek.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.